Okay, let's take a look at the most missed questions from the Chapter 3 and 4 exam, and this will be a review. Looks like in this review we've got most of the questions are going to be from Chapter 3. There's 9 of them, and there's 2 of them from Chapter 4. So let's take a look and see what we got. Okay, first question. Assume the perpetual inventory method is used, and they give you these transactions, and they want to know what is the amount of gross margin from the 4 transactions. Well, the first thing you need to know is what is a perpetual inventory system. Perpetual inventory system differs from a periodic inventory system. Since the periodic inventory system is just a snapshot of your inventory at one point in time, it really doesn't tell you much until you get to the end of a month or end of an accounting period. Whereas a perpetual inventory system is a real-time tracking inventory system, and as soon as you sell something, you record taking out of your inventory. So let's record these transactions and see what we got so we can come up with this gross margin. Okay, here's our accounting equation. Here's one asset inventory. Here's another one accounts payable. And the first transaction says the company purchased $12,300 worth of merchandise on account, and the terms were 410 and 30. 410 and 30 means that if the customer pays within 10 days, they get a 4% discount. Otherwise, if they don't pay within 10 days, they owe the full amount in 30 days. So we increase inventory under assets. We also increase liabilities under accounts payable. Now, let's see. The company returned $1,800 worth of merchandise to the supplier before payment was made. So that transaction is going to require us to reduce accounts payable by $1,800 and also reduce the inventory account by $1,800. And then it says we've got the liability was paid within the discount period. So the liability we owe on this is going to be paid within the discount period. So we're going to take this 4% discount. So we're going to reduce cash by $10,080. That would be the 12.3 minus what we returned, and then we'll take like I said, a 4% discount off of that. And the way we figure that is 12.3 minus 1,800 times 0.96, which is the same thing as taking a 4% discount. Anyway, when you run that through your calculator, all it comes out to is $10,080. So we will decrease cash by $10,080, and we'll also decrease a liability because all of the liabilities on their books, so we need to get rid of it, make it zero, by $10,500. And then the difference is going to be some type of discount account, purchase discounts. What's really important to understand here is we could have done this. We could have reduced cash by $10,080 here and reduced accounts payable by $10,080 here and done nothing right here. And that transaction on that line would have been in balance because you'd have had a reduction of $10,080 here, $10,080 here, and a reduction of $10,080 here. The problem would be is if you don't remove all that accounts payable, it looks like you still owe somebody something, and you don't. But you were able to take this purchase discount. So let's see what else we got next. Transaction number 4. All the merchandise purchased was sold for $18,600 cash. All of the merchandise. So we're going to increase cash by $18,600. We're going to increase on the equity side sales, and that's the retail side of the transaction. And like I said, since we're under a perpetual inventory system, we're going to not only record the retail side of the sale, which is what the customer sees, but we're also going to take this sale out of inventory. So we're going to reduce the inventory by $10,500, and we're going to show a $10,500 reduction right here for cost of goods sold. So they want to know what is the amount of gross margin. Well, gross margin is going to be sales of $18,600 up here minus the cost of goods sold of, let's see here, of $10,080. Now remember, this cost of goods sold is this gross amount minus this purchase discount. So $10,500 minus $420 is going to give us a cost of goods sold of $10,080. And our answer for the gross margin is going to be sales minus cost of goods sold of $8,520. So 8520 is our answer, and just to check ourselves, we're going to make sure after all the smoke clears, this accounting equation is in balance. So this side's 8520, this side's 8520, and I believe we're ready to go on the next question. All right, next question. ABC Company sold merchandise that cost $2,200 for $3,400 cash. So here's our accounting equation. There's cash, inventory, retained earnings, and we're going to let's see, have $10,000 right here in inventory, $10,000 in retained earnings, and that's just to give us a good starting point to keep our equation in balance. And now I'm going to record this transaction up here. So we had a merchandise sale that cost us $2,200, and we sold it for $3,400. So what we'll do is we'll subtract $2,200 out of the inventory, and we'll also take it out of the retained earnings side as cost of goods sold. Remember, that's the cost side of the transaction because we're operating under a professional inventory system. And then we'll also record the retail side of the transaction, which would be an increase to cash for $3,400 and an increase to sales for $3,400. And let's see, what else they want to know here. The merchandise was later returned by the customer for a refund. So what we'll do there is just reverse this transaction. So we'll put back in the inventory, back on the books. We'll increase that by $2,200. We'll get rid of the cost of goods sold, getting rid of that. We'll also reverse the retail side of the transaction, which is the sale. We'll take the sale off the books by refunding the customer's money by crediting cash, or excuse me, reducing cash by $3,400, and we'll also get rid of sales by $3,400. Instead, we'll call it sales returns. It's a good idea to keep these two separate because then you can tell how much of your sales are being returned as opposed to having them all into just lump sum sales, and it'd be a little harder to pull that number out of there. What else we got here? What will be the effect of sales returns on the total assets and total equity? Well, the answer here is this. The sale return, which is this line right here, this whole little thing below the blue line there, will increase assets, that is inventory, which in this case we've got inventory is going to go up. It'll decrease cost of goods sold, that's right here. It will also increase equity by $2,200, which is this $2,200 cost of goods sold item right here. So that's what we're looking at right there. Inventory goes back up, and so does the cost of goods sold over on the equity side. All right, so let's take a look at, oops, okay, I'm sorry, we still got some more to go on this problem. It will also decrease assets, cash, which we did right here, and decrease sales revenue, which is this right here, sales return, which will decrease equity by $3,400. Okay, so the net effect of all these things under the blue line here would be this. The net effect is a decrease in total assets because this asset cash goes down, this asset inventory goes up, and the difference here means we have a net decrease in assets. And we also have the same, which is $1,200, and we'll also have the same decrease, that is in equity, because cost of goods sold situation here, that when we return the item, that made the cost of goods sold here increase equity, and the sales return reduced equity. So overall, equity is going to go down also by $1,200. So the answer is that when we have this return, the assets and the equity side are both going to go down by $1,200. Number 4, let's see. What will be the effect of the sale will have on the company's inventory account? I always want to make sure that I know exactly what the question's asking me before I start trying to work something out. So that's the question they want to have answered, which is, what will be the effect of the sale on the company's inventory account? So here's our accounting equation. Cash, a couple of accounts under assets. And let's see, it looks like we know we're going to use a professional inventory system. The company purchased an item of inventory for $105. Okay, so cash goes down 105 and inventory goes up 105. And sold the item to a customer for $180. So when we sell this inventory for 180, we're going to increase, we're going to decrease inventory for 105. That's what we cost. That's what it cost us. And we're going to increase, hang on, let me get my thoughts straight here a little bit. So when we buy this inventory item, cash goes down, inventory goes up. And when we sell this item, inventory goes down by 105, and also under equity 105, we're going to make equity go down with the cost of goods sold. So we're taking out inventory. So what will be the effect of the sale on the company's inventory account? And we'll also are going to show the retail side of this. So let me answer this question in just a second. So we've got cash is going to go up 180, and revenue or sales is going to go up 180. And so the answer will be the sale will cause the inventory account to decrease by 105, which is the cost of the item. I showed you the whole entire transaction here, which was the retail side and the cost side. And all they wanted to know was what will be the effect of the sale on the company's inventory account. Well, the company's inventory account is going to go down by 105, period. All right, so that's the cost principle, because when you buy inventory at a certain dollar amount, in this case it's cost of 105, then you can only reduce the asset account by what it cost you, which is 105. That's called the cost principle. Okay, next one. We want to know what is the ABC company's gross margin for year 2. So for year 2, we're going to put up this little format for an income statement, which that's the way I like to solve the problem. We'll have sales minus cost of goods sold equals gross margin. That's what we're looking for, is gross margin for year 2, which would be these transactions right here. And you could also, you don't have to, but you could also say operating expenses are going to be subtracted from gross margin to get net income. So let's see what we got. So we have sales of $1620. That's the second item here, where the company sold inventory that cost $9,000 for $16,250. So sales are $16,250. And we have the cost of the inventory was $9,000. That's in the cost of goods sold. And all they want to know is gross margin for year 2, which in this case would be $72.50. So all the information up here for year 1, irrelevant. All the information up here about operating expenses and so on and so forth, that's all irrelevant. All we really care about is $72.50. Next one. They want to know the amount of retained earnings at the end of December 31st, year 2. Well, what we're going to have to do is figure out what happened in year 1 and get a balance for retained earnings, and then what happened in year 2, and kind of combine year 1's retained earnings beginning balance with what happened in year 2 to get the ending retained earnings balance. So let's do all that. So here's a little, excuse me, a little sales grid income statement format for year 1, and we'll plug in what was relevant for year 1. Sales of $8,400. That came from number 3, part of the question, where we had company sold inventory at a cost of $43. They sold it for $8,400, so that's sales of $8,400. The cost of inventory is $43, so it's subtracted off. We got gross margin of the difference, which is $4,100. Now we'll subtract off operating expenses, which would be $3,800. Now we have net income of $300. Now, that's the only thing that's going to affect retained earnings from this year 1's information. So we have an ending retained earnings balance in year 1 of $300. We'll then start looking at year 2, and we'll bring that $300 forward into year 2 as the beginning retained earnings balance. So in year 2, we've got sales in year 2 of $15,000 cash, right from this third item, or second item rather. We got the cost of that inventory that we sold, $8,500, which is right here. That difference will be a gross margin of $6,500. Subtract off operating expenses in year 2, which were $4,800, and we get net income of $1,700. Now we had a beginning retained earnings balance of year 2 of $300. We're going to add that to the, add income to that to get the ending retained earnings balance of $2,000. So $300 from year 1 plus $1,700 from year 2 gives us $2,000 from year 2 total ending balance. Looks like excuse me. Let's look at the next one. Number 9 here. They want to know what would be the total increase to the inventory account. All right, so Inventory cost should include, and here's what's really key about this problem is they want to know in this problem some things about inventory. So inventory cost should include anything that is an ordinary and necessary to get the item ready to sell to the customer. Anything that's ordinary and necessary to get the item ready to sell for the customer. So keep that in mind. Here's our accounting equation. And we've got cash, inventory, a couple of assets. And the first thing we did is the company purchased $32,000 of inventory from the XYZ company. So this is the accounting equation of ABC company. So the inventory is going to go up $32,000, and we're going to reduce cash by $32,000. It really doesn't tell us how they paid for it, but we're going to assume it was cash. Okay. Next, ABC also paid $2,500 freight costs to have the goods shipped to its location. This is something that falls under this category right here. Is something that's ordinary and necessary to get the goods ready to sell to the customer. So anything you have to do, like in this case a freight charge that you paid for, that should go in the cost of the inventory because you needed the freight to get it to your doorstep so you could then sell it to the customer. So that's going to decrease cash by $2,500, increase inventory by $2,500, and that'll be part of the cost of inventory. Anything else? So the answer here is, let's see, we'll bring this accounting equation forward. So it looks like we've got cash that's going to go down 34.5, total 34.5. Inventory is going to go up 34.5. So it looks like all of the transactions were reducing cash, increasing inventory. And the answer is when the perpetual inventory system is used, the inventory count is increased when the inventory is purchased. So the answer here is that what will be the total increase in inventory count? Well, like I said, in this case, the transportation is part of the cost of inventory. And so the total inventory count is going to go up by $34,500. Let's look at the next one. Oh, on my job, I don't really get a lot of money for teaching, so I had to supplement my income by writing songs, and I've written a lot of country songs. And so here is just an example of how an accountant would write a country music song. You take some lyrics and you put them on a grid like an Excel spreadsheet, and then you can in this particular grid I can probably put out maybe 7 or 8 songs. You just, for example, you just take and go either this way in the grid or with the lyrics, or you go down this way for the lyrics, or you can go this way with the lyrics. Any way you want to go, you've still got lots of ways to make up country music lyric songs. Let's go on. So let's see what we got here. Now, let's go on to our next question. All right, in this problem they want to know the gross margin from transactions from ABC company. So here we go. Here's our accounting equation. Cash, inventory, accounts payable. First thing we did was when company purchased merchandise inventory that cost $16,300. The terms were 410 and 30 FOB shipping point. FOB shipping point means the FOB stands for free on board, and shipping point is whatever words come after the word FOB, that's where the goods change hands. That's where the goods become, in this case, a shipping point means when they ship them, they're now the ownership of the person who's buying them. So let's go on a little further. So if we bought these goods, FOB shipping point, and we paid $16,300 for them, then inventory goes up $16,300, accounts payable goes up $16,300. The company paid freight of $630 to have the goods delivered, and so like I said, here's another explanation of how this FOB shipping works. Like I said, FOB shipping point is you're selling these goods to someone, and as soon as, if it's FOB shipping point, that means the title transfers right here as soon as they leave the dock. Okay, that means they're the buyer's goods. Another type of shipping is called FOB destination. which means if the seller sells some goods to a buyer, then if it's sold under FOB destination terms, then the title doesn't transfer until they actually reach the buyer. So FOB shipping point, FOB destination will determine who really owns these goods and at what point they own them. So let's go a little further. So the company paid a freight of $630 to have the merchandise delivered, and so we're going to reduce cash by $630 and increase inventory by $630. And remember that this freight is an ordinary and necessary cost to get the goods ready to sell. Therefore, it goes under as part of the cost of inventory. The next thing we'll do is we have a payment made to supplier within 10 days. So our terms were $410, which you get a 4% discount if you pay within 10 days, which they are, and it's net $30 if you don't pay within the discount period. So, but we did, so we're going to make this payment, and we're going to reduce cash by $15,648 and reduce accounts payable by the full amount, $16,300, and then show under equity this $652, which will be a purchase discount. Next, we've got all of the merchandise was sold to customers for $24,100 cash. So cash is going to go up $24,100, and it was delivered under terms FOB shipping point with freight cost amounting to $430. All right, now this is freight out, because when you sell something to a customer here, you're gonna have in this case freight out was $430. This freight up here was freight in, that is freight to get the merchandise to your door. Now when you sell it to a customer, that's freight out, and that's a different, you handle that transaction a little bit differently. So taking the 24.1 and also under equity show sales of 24.1, and that's the retail side of the transaction. And now we're going to, since we're under a perpetual inventory system, we're going to also show the cost side of that inventory transaction. So we're going to take $16,930 out of inventory, which is this, the cost plus that freight, and we're going to show that as a cost of goods sold. Okay, so that's the retail side of the sale, and that's the cost side of the sale. And then another $430, since we paid that $430 for freight, we're going to we're going to reduce cash by $430 and also reduce equity, because that's another expense to us under freight out. And this particular freight expense is freight expense under operating expenses, where the freight up here we paid was part of the inventory, and it goes as part of inventory cost. So it's two different things altogether. This will go as a, let me just say this, and I hope that didn't confuse anybody here, but when we spent this $630 on freight, notice that the entire $630 was part of this cost of goods sold right here. The $16,930 was part of the cost of goods sold section. It makes a difference as to where you put this. So this is part of the cost of goods sold, whereas this freight out to the customer, goes under operating expenses. So that freight went under cost of goods sold. This freight goes under operating expenses. It makes that's a significant thing there. You add all this up to see we're still in balance. So cash now, after all this has gone on, is $73.92. Our inventory account is zero because we sold it all. Accounts payable account is zero because we paid for it all. And then we have an ending balance in equity of $73.92. So now let's see. They want to know what the gross margin is. So here's gross margin. Gross margin will be sales of 24.1 minus the cost of goods sold, and the cost of goods sold will be this 16.3 times 0.96 times 600 plus $630, and I believe all that comes out to 16,930, and this gives us a gross margin of 78.22. Back to this one more time. That 430 would not be part of this gross margin calculation. It would go underneath under operating expenses. Okay, I think that's all we're going to do on that one. And reminder, freight in, which is what this is up here, is cost of goods sold item. Freight out, which was this 430, is an operating expense item. Really important to keep those two separate. Okay, let's go on number 13, or the next one. They want to know what is this situation going to have is going to be what's the effect on the sale on the income statement. Here's our accounting equation: cash, accounts receivable, inventory. First thing we're going to do is ABC Company sold merchandise on account for $15,700. They sold it on account. So when you sell something on account, you don't get any cash. You set up an accounts receivable, customer owes you $15,700, and you also have a sale for revenue. So both sides go up by $15,700. That is the retail side of the transaction. And then this merchandise cost is $8,600. So selling merchandise on account will increase revenue by $15,700. Yes, okay. And we want to reduce this inventory by what it cost us, which was $8,600. And also under equity, we'll have a cost of goods sold of $8,600. And they want to know what is the effect on the income statement. Well, the effect on the income statement is sales will go up by $15,700, and expenses will go up by $8,600, which is the cost of goods sold. And it looks like we've got our accounting equations in balance by $7,100, which is the net effect of how much we have as a gross margin, which is what this really what this sales effect will be on the income statement. It'll increase gross margin by $7,100, which is revenue minus expenses equals net income, which would be $15,700 minus $86,000, which is $7,100. Okay. Let's see, do we have another one here? Let's see. I have another one here. And so ABC Company had the following results during 2017. We've got net income, $87,900, cost of goods sold is $355,100, gross margin is $165,000, and then we want to know what were sales. Well, in this problem, we're going to have to work backwards. So let's plug the things in we know into this little income statement format and solve for sales. So the first thing we're going to do is, like I said, we're going to work from the bottom up. So we're going to put in the income first. Net income is at the bottom, $87,900. Next, we're going to put in gross margin, which is $165,000. And let's see, if we wanted to, we could figure out right at this point what operating expense would be, which would be the difference between gross margin and net income, which would be, in this case, well, let's see, I guess we didn't figure that out, but we could figure it out if we wanted to. But it's really not necessary under the question we just want to know, which is what are sales. So cost of goods sold are $355,100. So now, like I said, we didn't have to figure this out, but we do need to figure sales out because that's what the question wants to know. And so something, which is sales, minus $355,100 equals $165,000. And so how do you get that unknown? Well, you just add these two together, right? And when you add them together, you get sales of $515,600. Let's see if we have another one here. Okay, now we're on to the next chapter, and yes, we have one more here. So, reconciling a bank account. Do you and how do you do it? So, let's see. Raise your hand if you reconcile your own bank account. Okay, yeah, I got my hand raised. Okay, now, how do you do it? Well, you probably do it on your phone, I don't know, but I do it with an Excel spreadsheet. And so let's see what we got here next here. The bank reconciliation reports on the difference between the balance on the bank statement. You know, when you get a bank statement every month, you see what a balance you've got there, and the balance in the general ledger account. So if you were keeping books, like with QuickBooks or some other accounting software, you would have a general ledger balance of cash. You would compare that to then what the balance in the bank statement said, and you would try to find out what the differences were and do a reconciliation so that you would have the true balance of cash. And that's what we're trying to shoot for, is the true balance of cash. All right, so here's something like what a reconciliation would look like. It's a simplified form. So what you're going to do here is you're going to have a bank side, which is this is the bank side, okay, and you're also going to have a book side. And what you're trying to find out is what things on this bank side that the bank doesn't know about, okay, and then also over here on the other side, on the book side, what are things that the book balance doesn't know about? Well, here's some examples. For example, on the bank statement side, the bank won't know about things like deposits in transit, things that you put in the bank that the bank hasn't recorded yet. They also won't know about outstanding checks. That's something you're going to have to add in deposits in transit on the bank side and deduct outstanding checks on the bank side to get to this true cash balance. Over here on the book side, you start with what your computer tells you or your phone tells you, and you'd have to add things that the books wouldn't know about, and they wouldn't know about them until you got a bank statement. So in real life businesses, not just personal accounts, but in businesses, there are businesses that are large enough that have banks collect accounts receivable for them, and they don't know what they collected all together until they get their bank statement. So here's something you would have to add to the book balance, which would be accounts receivable collections. You'd also have to add any interest that you've earned, and you won't know that until you get a bank statement. You'd also have to deduct any bank service charges, and again, you won't know that until you get the bank statement. And then finally, you would have to deduct any NSF checks, which are going to be a check that someone gives you, business gives you, whatever, that don't have any funds behind it and it bounces. And so you have to deduct that. You won't know that until you get your bank statement. Anyway, all these things will be considerations to come up with this true cash balance. And when all the smoke clears, both of these true cash balances on the bank side and the book side should equal. All right, given all that, let's take a look at this question here. They want to know what is the true cash balance as of April the 30th. So, bank side, book side. Let's go down through these transactions and see if we can come up with the true cash balance. So, let's see. We start off with an unadjusted bank balance. It says the April 30th. By the way, we're doing this for April 30th. So, that's good to keep in mind that all this information is going to be for the true cash balance as of April 30th. And it shows that the ABC Corporation shows an ending balance of 35, the bank statement that is, shows 35,649 as the unadjusted bank balance. So start with that on the bank side. The unadjusted cash balance is 29,550. Put that over here. Now, look at these 5 things and we have to figure out what effects they're going to have on either the bank or the books. So there was a deposit in transit of 4488, and that's something that the bank doesn't know about, so we'll add that to the bank. Next, the bank statement reports a service charge of $69. That's something the bank knows about, but the books don't know about, so we'll deduct that service charge. Then we have a credit memo included in the bank statement shows interest earned of $255. The books don't know about that, so we'll add that to the book side. And then outstanding checks total $11,571, and that is adjustment on the bank side, and you'll have to deduct that, right? And then finally, we have a bank statement included a $1170 NSF check deposited in April. The bank knows about it, but you don't know about it until you look at the bank statement, so therefore that's going to be deducted from the book side. Now, hopefully, when we combine all these amounts on each side, we'll come up with this true cash balance. So when you combine everything on the bank side, you get 28,566. Combine everything on the book side, you get 28,566, and we're all good. I think we got a couple more of these here. So let's go on. Next, it says at March 31st, so on and so forth, so on. They want to know what the true cash balance is, so we'll start with the adjustments per bank to the bank balance, adjustments to the book balance, and then we can start putting this information in here. So March 31st, we had a balance in the cash account of 11,300, so that's on the book side, 11,300. At the end of March, the company determined that it had outstanding checks of $1290, and that's something that will be deducted from the bank side. Okay. Deposits in transit were 780. That's also something that the bank's going to be adjusted for, which is going to be an increase by 780. Bank service charge would be $50, and that's something the books don't know about, so we'll reduce that on the book side. And then we have an NSF charge of customer charge of $230, so we'll deduct that from the book side. Now, this is an interesting little question here because they want to know what's the true cash balance at March 31st. Well, you don't have a beginning unadjusted bank balance over here. I put these over here just to show you where they would go, but you don't really have anything to like subtract them from or add them to, whatever. But you do have information over here on the book side. You started with an unadjusted balance. These are the things that affected the the books. So we'll adjust these, and we end up with a true cash balance of 11,020, and that's the answer we're looking for here. And what you have to assume in this problem is they gave you two pieces of information that were just irrelevant. You didn't nearly need to have them anywhere. And the only way you can come up with a true cash balance is to adjust what you've got to work with, which in this case is all the information on the book side. Okay, so not enough information on the bank side to cross the checks and so forth, and so you have to use this as the true cash balance, which is the book side. We have another one here.